Welcome back to Alpha Recap. Markets closed up today, and we had a tech-led rally meeting a wave of corporate resets and disclosures. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everyone, great to be here. Today felt like a classic mixtape. Indexes were smiling, but when you dug into company filings and headlines, there were pockets of real caution.
Totally. The Nasdaq led gains, and the S&P 500 hit a session high, driven by big tech names. We saw strength from Tesla, Meta, and Microsoft, among others. But underneath that, there were three stories that stood out. Corning's big growth commitment, Amazon's fresh round of corporate layoffs, and a pile of Form 8Ks that can create idiosyncratic moves.
Let's start with Corning, because that one was huge. They beat fourth quarter expectations and they upsized their springboard plan to target about $11 billion in cumulative sales by 2028. That's not small talk, it's a multi-year commitment.
Right. For listeners who don't live in corporate planning speak, the Springboard Plan is Corning's effort to commercialize growth platforms. Think optical communications, specialty glass, life sciences, and environmental tech. Saying about $11 billion of incremental sales means they expect material, new contracts, and product ramps over the next few years.
And the market rewarded that. Stocks that can point to multi-year structural revenue lifts tend to get a premium because investors see more predictable top-line growth. But Marcus, you and I both know execution risk lives in the details. Segment cadence, margin mix, backlog recognition.
Exactly. Beat plus a big target reduces uncertainty a bit, but we'll be watching how those revenues show up, whether they're recurring or lumpy. Investors should look for segment-level disclosures and margin changes as Corning executes the plan.
Switching gears, Amazon announced roughly 16,000 corporate job cuts today. This was their second large reduction since October, when they cut around 14,000. Management framed it as anti-bureaucracy, streamlining decision-making and removing duplicate roles.
That's a real trade-off story. On one hand, cost discipline can lift margins and free up cash for investments. On the other hand, big corporate cuts can hurt morale, slow cross-functional projects, and risk near-term product velocity. Analysts were split on whether this was overdue efficiency or a potential execution headwind.
For everyday investors, that means you should be asking, how much of the cost savings is structural and recurring? And what could get delayed or degraded because of fewer people working across the business?
Good point. The layoff story tied into the broader theme of the day. Markets shut the day higher on growth appetite, but corporate actions were sending mixed signals about where future earnings will come from.
Also on the radar, Goldman Sachs kept a neutral rating on AbbVie while waiting for 2026 guidance. And Caterpillar had their fourth quarter on deck, where dealer inventories and margins were the key focus. Those were immediate catalysts investors were watching.
When big analysts go neutral before guidance, it often compresses volatility until the disclosure comes out. So the overall market can rally, but pockets like pharmaceutical guidance or industrial results can still create sharp moves once the data drops.
That brings up another less flashy but very important point from today. A bunch of companies filed Form 8Ks. Xerox, Teva, Lennox, California Bancorp, and Central Pacific Financial were among them, filing things like results of operations, Regulation FD notices, and exhibit attachments.
Let's pause and explain Form 8K and Regulation FD in plain English, because those filings actually matter. A Form 8K is a near real-time disclosure that companies use to tell the market about material events. Regulation FD is the rule that says companies can't selectively leak material information to some investors and not others. Those exhibits attached to 8Ks can hide important stuff, one-time charges, reserves, or operational shifts that don't always show up in the headline index numbers.
Exactly. For active traders or event-driven investors, those exhibits are where you find the nuance. A headline might say, filed a Form 8K, and the stock barely moves, but the exhibit could contain a surprise that drives a big intraday move later.
So today felt like bullish breadth on the index level, but with a bunch of idiosyncratic landmines around corporate disclosures and cost actions. And don't forget macro risk. Fed Chair Powell's remarks were a focal point for the tape, and those were being watched as a potential re-rating factor.
Right. When markets are cruising higher, they still need macro clarity to stay comfortable. Powell's words were able to move markets when the central tendency of the Fed was uncertain. So traders were paying close attention to what he said, and were getting ready for more company reports in the near term.
Let's talk about where analysts didn't agree today. Corning was broadly rewarded, but some observers questioned how much of that $11 billion uplift was timing sensitive versus structural. Amazon split the street between efficiency believers and execution skeptics. And AbbVie sat under a neutral mantle pending guidance, which is a cautious posture compared to the market's risk-on tone.
That difference matters for investors. If you own Amazon, you have to weigh potential margin gains against possible revenue or innovation slowdowns. If you own AbbVie, you might choose to wait until we see that 2026 guide. And if you're in Caterpillar, dealer inventory levels could confirm or bust the cyclical recovery thesis.
On Caterpillar, which we were watching, dealer inventories are essentially the supply chain signal for end market demand in construction and mining. If inventories were high in the quarter, that could point to softer replacement demand and margin pressure. If inventories were lean, revenue upside could be next in line.
So for different investor types, the implications were clear. Growth investors probably liked today's tech leadership and Corning's big plan, but they also faced more volatility around guidance events like AbbVie and Caterpillar, plus the news shock from Amazon.
Value and cyclical investors had a potential win if Caterpillar's quarter showed recovery. For income and defensive investors, neutral analyst stances help stability, but regional bank filings from Central Pacific and California Bancorp meant you should check localized credit or operational items before assuming dividend safety.
And event-driven traders were probably licking their chops. Multiple 8Ks and a concentrated earnings calendar create idiosyncratic alpha opportunities. But you need fast access to filings and a sharp news parsing process to avoid getting caught on the wrong side of a headline.
Let's get tactical. 5 practical steps we were recommending after the close. 1. Consider rebalancing with catalysts in mind. With Caterpillar's fourth quarter, AbbVie's guidance and Powell's remarks all near-term, trimming high beta exposure or using hedges was reasonable.
2. Read the exhibits. Don't treat a Form 8K headline as the whole story. The exhibits often contain one-time charges, reserve changes, or nuance that matters for near-term returns.
3. Monitor Corning's segment cadence as they pursue that about $11 billion target. Are revenues persistent and margin accretive, or are they relying on backlog recognition and timing?
4. For Amazon, price in both margin upside and execution risk. Model expected cost savings against potential disruptions to product delivery and revenue initiatives.
And 5. Keep an eye on dealer inventories for Caterpillar. Inventory trends were going to be the practical test of how strong global construction and mining demand actually was.
We should also remind listeners of the strategic posture that fit the day, neutral to cautiously constructive. Participate in momentum, but protect against guidance misses and event risk. And use the disclosure volume to hunt for mispricings.
Before we wrap, quick listener-friendly recap. The tape closed higher with tech leading. Corning surprised in a good way and raised a big multi-year target. Amazon cut about 16,000 corporate roles, which was the second major layoff since October. Several companies filed Form 8Ks that could cause idiosyncratic moves, and key catalysts like Caterpillar's quarter, AbbVie guidance, and Powell's remarks were still shaping near-term risk.
And action items: read the filings, size for execution risk, consider hedges if you're high beta, and keep the catalyst calendar on your dashboard.
Final takeaways in one line each. Takeaway 1. The index rally was real, but it masked company-by-company differences. Don't treat the table of contents as the whole book.
Takeaway 2. Corning's plan was a positive structural sign, but investors should verify recurring revenue and margin quality as the plan unfolds.
Takeaway 3. Amazon's layoffs could lift margins, but they also increased execution risk. That trade-off needs to be quantified.
Takeaway 4. Form 8Ks and Regulation FD notices were the quiet story today. Read exhibits to find the nuance.
Takeaway 5. Keep a neutral, tactical posture. Participate in momentum, but protect against guidance misses and event risk.
That's our read. If you want to dig into any of the filings we mentioned or get our take on a specific name, go to stockalpha.ai and ask us a question.
If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next set of earnings and Fed commentary to unpack what actually moved markets.